You have a pension. Should you take the lump sum or should you get the lifetime income? That's a question you see a lot. And I'm going to break that down. So, ladies and gents, just here to drop a few cents. You're with Earl, the money coach, a decade licensed in the financial industry and 2 decades of investment portfolio experience. Want to break this down as this is a very common question I get for a lot of my clients, my older clients, or my government job clients that want to understand what to do with their pension. Should they take the lump sum or should they actually get lifetime incomes? But before we get into that, make sure you guys like, follow, subscribe. Check the description if you want to get a free budget, open up your health savings account, or schedule a consultation. But let's break down why things have changed. So, but if you want, you can skip forward. I'm going to timestamp it below. You can skip forward if you don't want to hear the history, but I'm going to break down the history of the pension. That is what most people know a DB, which is a defined benefit. You have DB, defined benefit, and DC, defined contribution, which a lot of companies kind of switched over to. You guys may know it as a 401k. Now, pensions, a DB, a defined benefit. When pensions first came out, the idea was, look, you worked for us 30 years, you bent your back, broke your back doing all this stuff for us, we're going to take care of you. But folks, when pensions first came out, listen to this. A lot of people don't understand when pensions first came out, and Social Security, that's a whole nother topic. But when pensions first came out for retirement, retirement was 65, but life expectancy was only 61. What does that mean? Most people never made it to retirement. Most people never made it to 65. Only a very small amount. And if they did make it to 65, they start withdrawing for their pensions, what? A year or two, maybe 3. Most companies say, you know what, we could deal with that. Fast forward to now, 2025, what do we have? People living average life expectancy is now 87 years old. So you went from not everyone using it, barely anyone needing pensions, to now everybody needing some kind of retirement plan for next 15, 20, 25 years. Companies can't take care of that. So they needed to come up with something new, which is why you hear the DC, the defined contribution, where us as the employee take care of your own retirement for yourself instead of the company. And you're seeing a lot of decline. I got my computer here. I'm going to read you guys the most updated stats, but this is huge. Now, the share, all right, the share of U.S. workers that were underneath defined benefit plans dropped from 59% in 1989. So almost 6 out of 10 people had some kind of pension plan or something that a defined benefit through the company taking care of them. To now, we're talking 21% in 2022. So that's a huge, we're talking almost a 40% drop. And think about this, when it comes to these kind of plans, only 15%, right? 15% of private industry workers even have pension plans, pretty much a way of how they could do that through their company. Meaning, if we're talking about a government jobs, some of their local jobs, private industry workers, only 15% of their workforce actually could have an option of a defined contribution benefit plan, like a pension. But out of that 15% of jobs, only about what? What's it showing here? Only 11% of people actually have a pension plan. So out of that 15% of jobs, about 1 out of every 10 actually have something where they can have a pension plan. So you see, it's very small, a very small group that you have there. So the question is, to get back to the topic, should you take a lump sum or should you have lifetime income? Well, understand when it comes to pensions, you have those two options, but how do those options work? This is huge, folks. This is huge. If you have, some companies are different, they may have a few perks, but generally speaking, if you have a pension, okay, and you elect lifetime income, you have forfeited the rest of the contributed amount inside that pension. So let's give an example. Let's say you have $200,000 inside a pension and you get $3,000 a month. Just making up numbers. You get $3,000 a month. 200,000 in the pension. You get $3,000 a month. So let's say for 4 months, that's $12,000 you got from your pension, and you pass away. Guess what? The rest of that $170,000, $180,000 that you haven't touched yet, that's been forfeited. your beneficiaries can't get anything. So that's huge. Some pensions are different, but for the vast majority of pensions, if you elect lifetime income, you forfeit the amount, the whole amount that you have within that pension that's contracted and structured for you. So that's huge to think about. Or the second option is taking the lump sum. Now, when you take the lump sum, guess what? You're going to have taxation. You're going to have certain things you have to go through. That 200,000 you may get, say, depending on your income bracket, your state, and all that, you may get 150, 140, maybe even less. So I tell people that is huge to understand. But look here, this is huge. I tell a lot of people, when you start taking out these pensions, you start taking out plans like that, what is your end goal? The reason why, look at this. Of retirees who took a lump sum from a defined contribution retirement plan, okay, or defined benefit, depleted the lump sum within 5 years. Okay, that was a study done by MetLife in 2022. So 34% of people depleted all of that within 5 years. So they didn't have another goal. So now that you took that lump sum out your pension, what did you do? Did you put it into the market? Did you put it into IRAs? Did you use annuities? Did you use municipal bonds? Whatever. What did you do with your funds afterwards? So when you can get the lump sum, and I tell people I'm not here to dictate what's better. If you want to get lifetime income, hey, consult with a financial professional that knows your specific needs. If you want to sit down with me, click in the description. We could sit down and have a consultation. But if you have a CPA, an accountant, someone who's doing everything right now, please consult with them to make sure you make that right decision when it comes to that. Because both of them could be used different ways. For me, a lot of my clients, one of my clients I just recently had, we just did that. They got a lump sum from their pension, which is right around 300,000. It was like 308,000. So we took, after taxation and all that, we took 300,000. We put that into a annuity. That annuity company gave them a 27% bonus. So day one they had 300,000 plus the bonus in their account principal was 381,000, which is able to kind of play catch up for all that taxation that they lost for that lump sum. Not everything, but it gave them a good amount. So you have to look at different things. But let me go right here. These are huge things that people always want to know. These are the top questions, and I'm going to answer them like I see it. Should I take a pension buyout or stay with lifetime annuity payments? Kind of like what I just said. Consult with someone who knows your specific needs. If someone's just telling you, yes, you can move this automatically, most likely they're in sales. They're just trying to make a quick buck. Figure out what your specific needs are. If I'm sitting down with you, we're going to go through your budget to make sure you have enough emergency funds. What do you have liquid? Because if you're taking lump sums, what do you plan on doing with that lump sum to make it extend? If you're taking that lifetime income, guess what? That's just a little bit. How are you going to make supplemental income? We're going to go through all that if me and you sit down. But if you have a financial professional, make sure you sit down here. Now, the second biggest question is, how do you calculate which option gives you more value? Well, honestly speaking, it comes down to longevity. For an example, you retire at 65, my family specifically, and when you look at folks who die from older age, we're talking early 90s. I have both my grandparents, I've had uncles and aunts from both sides of the family that 87 years old, 92 years old, 80, we know how that works. So if I retire at 65, am I going to have that lifetime income where I can get that? Is it going to be enough to sustain that 3% merit increase do I need? Or am I going to put it into a lump sum and get more value? For me, like I said, I've been investing for the last 2 decades. I could take that lump sum and probably have a great return with it. Most people may not have that success. So you got to see what's better for you in the short term and the long term if you're taking out a lump sum or doing all that. Now, what are the tax consequences of taking the lump sum? That's huge. Obviously, there's going to be tax bill. Let me just see what it says here. Obviously, you're going to have a lot of taxation because now it's going to be considered income. So think of it, whatever you have coming in plus your anything else that you have, in this case, your pension lump sum, is going to be considered income. That may make you jump up to a whole nother bracket from 12% up to 24%. Now you got to have taxation on that since it's been considered income. All right. Now, if you roll those funds over, you roll your pension into a fixed index annuity, roll your pension into other strategies, guess what? You're not worried about that taxation all up front. Now, you may have a little bit of taxation down the road on the principal, but then in your annuities, everything gets to grow tax free. If you put your money into a Roth IRA, you'll still have a little taxation on that principal that you put in, but then you get that tax free growth. So that's a great thing to look at. So I tell people you need to understand that because taxes is what kills a lot of people. Now, what happens to your pension payments after you pass away? Like I explained earlier, generally speaking, your annuities are great. I talk about annuities because you could roll your money from a pension to an annuity, and the old annuity was just like a pension. You forfeited everything. But with your new annuities, guess what? You could have lifetime income, and if you have principals, same scenario. You have 200,000, you live for 4 months, that's 12,000, then you pass away, guess what? The other 180K that's still in that account, it could be sent to a beneficiary. So that's a huge option to have to know if you move your money to certain kind of accounts. If you leave it in your pensions, a lot of times, like I said, not every company, there are a couple exceptions, but the vast majority, if you do lifetime income, you're going to forfeit that beneficiary. Something happens to you, your family, like they say, is SOL. Then the fifth biggest question: how does interest rates affect your decision? This is huge. What you have to think about is what is taxes going to be down the road? What is inflation going to be down the road? Are you able to still use compound interest? Have you paid off everything? Most people would hope and assume they would pay their house off by the time they hit retirement. But what if you just moved when you were a brand new house when you were 58 years old? You still have over 20 years left on that mortgage. So you got to look at, am I going to be able to live off just that lifetime income? Even if some companies will give you a merit increase. Some companies, look, that's what it is. You're going to get 3.2% of whatever you have for the rest of your life. That's what you get for the rest of your life. So that's where moving lump sum, when you have a pension and you move it to a lump sum, you can still have it growing for you. That's huge. Move your money somewhere else. Let it still get compound interest. The rule of 72, take the number 72 divided by your interest rate. That's how long it takes money to double. So if you get yourself 8, 9, 10%, hey, every 7, 8 years, that money's still compounding, that money's still doubling. I'm still good to go. So these are things that you need to understand. If you want to have a pension, should you take the lump sum or should you take the lifetime income? I say, in conclusion, look at the value of life. If you think you're going to live a long life, is that lifetime income going to be enough? Probably not, unless you have other things as well, supplemental incomes. You got 2,000 from your pension, 1,200 from Social Security. You got an IRA giving you 1,500. You have real estate property giving you 2,000. Supplemental income, put all those together. If you don't have all that, most likely a pension and Social Security is not going to be enough. I've seen clients that literally they're scrounging nickels and pennies because they can't afford it. Just have a pension, they just have Social Security. They can't afford it. If anything goes up $5, $10, it messes up their whole lifestyle. So you got to understand that you don't want to be stuck. So, but on the flip side, on the lump sum, what are you going to do? You're going to have taxation. You can move it to different kind of accounts. One of my favorite are annuities. You look at my channel, I talk a lot about annuities because you could get a bonus. You may pay 25% in taxes. Some companies could give you a 25% bonus for moving the funds over, kind of give you a wash. Not every company does that, so you need to look at what could be the greatest situation for you if you have lump sums that you want to move. So, with that being said, folks, I hope this is great information. If you have a pension, you could reach out to me. We could talk about what possibly could be done. If you have a CPA or you have a financial advisor or someone already, figure out the pros and the cons because you need to look at your whole portfolio. That's a huge mistake. People will have pension plans or 401ks, and that's all that's in their portfolio. So they expect a pension, Social Security, 401k, Social Security. Everything's paid off. You need to make sure your whole portfolio has a lot of different streams in there so you can be good to go. So if you do want to be a little bit risky and move your pension, you could take that lump sum and then split that up and diversify it to different portions of a portfolio. or you could have the lifetime income as part of your supplemental income. So with that being said, ladies and gents, just here to drop a few cents. You were Earl, the Money Coach. Make sure you like, follow, and subscribe, and I'll see you on the next one.